Hey, good evening. This is Ken Long from Tortoise Capital with the review of the weekend trading reports for June 23rd, 2012. Thanks to Paul. I will re-email out the correct daily. I must have grabbed the wrong file and put it in on the weekend report. So I'll get that. I'll review the correct one tonight and then forward that immediately following the webinar. So we'll just go ahead and get started. We're in a bullish, volatile market still. We're at 52 out of 100 on weekly RSI, so right in the middle of neutral. Right in the middle of neutral on the 10-day NDX at 52 out of 100, so that puts us bull, volatile, and neutral. Percent stretch above the 200 is 3.36, so we're only 1.5% above sideways. The slope of the 50 has improved slightly to minus 0.24%, but that's still red bearish. ADX ATR percentage about 1.5% keeps us well into the volatile. The blended monthly rebalancing keeps the same holdings, TLT, and a double scoop of SHY in both of the portfolios, with the next evaluation due on or about 1 July. In ETF2, the theoretical exposure is still at 0%, and the model portfolio is at 50% exposed. Next up is a quick look at the blended monthly portfolios. We still have only 2 on a cash position in the ETF 30, and that's the Treasuries and the U.S. real estate on buys. And then really the same story as last week. Treasuries, emerging market bonds, U.S. real estate, and then the short-term Treasuries are on a buy. U.S. tech is otherwise leading the way. And it's still the U.S. over the globals with technology, diamonds, spiders, mid caps, and small caps. In the extended set here, we have all the globals still are dragging behind. Brazil, Latin America, emerging markets still suffering. So no change in the lineup. Next up is the health check. The vertical blue lines represent 10, 20, and 30 days of look-back period. Horizontal purple line at 142 is the previous swing high from early April, actually late March. And then I'm showing targets at 135 and 133 as key resistance levels from the past. The 3 horizontal red lines represent support levels that have held before. That's at about 130.5, 129, and then 127 was the recent swing low. You can see now that the 200 period moving average has emerged onto our screen with the actual 200-day moving average is solid red, then everything underneath that in red is that ocean of despair. The solid black line in the middle is the 30-day regression line. The black lines on the outside of that channel represent the regression channel formed by the maximum excursion from the regression line during the look-back period, which was right around the 1st of June. The blue extensions are an Andrews pitchfork, which simply project that regression line forward based on if there was no underlying change in what's driving this regression line. And now you can see that it just about encompasses the bottom of this 10% pullback. The 2 rectangles on the right represent a 5% pullback from 142, which is at 135, which is the last place that it found resistance and failed in a big way. And then the 10% pull off. So between 0 and 5%, we would consider that to be noise in a bull market, and between 5 and 10% would be a correction in a bull, and between 10 and 20% would be would be a baby bear, and that coincides right now with about where we would expect the 200-day moving average to be at the bottom of this regression channel. So right now it's the 200-period regression channel, or 200-day moving average is the only thing keeping this really with bullish support right now. What's a little bit disturbing for the bulls here is if you'll notice the length of the sell-off days, that after grinding days up, even here where there was a sell-off, then some hesitation, sharp sell-off, grinding back up to 133, sharp sell-off, recovery back to 133, big one-day sharp sell-off, grinding move to 136, one-day sharp sell-off. So a lot of those bearish one-day moves were short, intense selling periods, have been erasing a lot of the gains being made on these shorter periods. Every one of those big red candles is a fantastic day for the frog. I'm just telling you. So while the market is grinding around here, having a frog on your side is a very good thing. I should say also, Bill Brower has finished his TradeStation his workbook, and has now shifted his priorities over to Tortoise programming, and so he's busy right now preparing the blended monthly rebalancing bundle for TradeStation. I've asked him to make the parameters very flexible and to allow for using the same general look back of blending relative strength in order to find relative strength candidates over different time frames. So it's going to be available to use, I think, right now, for swing trading and intraday trading, as well as the blended monthly. So he's looking at techniques for being able to truly backtest using TradeStation, and it looks fairly promising. I'll be sending out a note later this week inviting people who'd like to get a discount in the first round in order to help me cover the cost of programming. I'm looking at selling this one for about $1,500 to $2,000 out in the world, and so I'll make this one available to to the first wave of buyers and members here at probably about $1,000, and I'm going to limit that to the first 20, and that'll help me pay the cost of the research and then the programming. So more to follow on that, but it looks very promising. His second project after that is going to be the intraday frog, so I'm pretty excited about him turning his programming skills to that. So enough of that. So what we got is the river has rolled over. You can see that this move went from an extreme outside the river to just the far side of the river and fell right back to the mean. And what we have to see right now is a close above this swing high at 136, and then we can have some little more confidence in this bull. As long as it holds above 131, or this last red line here, I think we're in good shape. But right now the yellow zone is this area in here. It's got to close above 136 to be convincing. Now what's interesting, if you'll notice right in here, we have I think this is a special case of a long side entry for me. This is the perfect example of what I call max pain range compression. You have that huge red candle followed by a tiny little white doji inside the real body, and so a price above 134 with a target at 136 becomes very attractive. There's a nice little tactical trade setting up right inside here. So if we So I'm ready to go long above 134 with an initial target of 136 with about $1 risk, and that gives you a perfect 2 to 1 reward to risk ratio just inside that tall red candle. So that's sort of what max pain range compression looks like in the world, and I'll be ready to trade that one on Monday. Some other observations to note. The slope of the regression line has come back up to positive, so that's good. For the longest while during this period it was down, and now the short term has actually started to pull up, so that's actually favorable. For this really to be convincing, it's got to get above 139 and never get below this, I would say, 127. If it goes below 127, it really hurting. So I would like to see it hold above 131 and then get up into this area and test the previous swing high. So we're in tactical range right now. Still bull volatile. You can notice the bulls are slightly in charge on ADX. However, you know, the trendingness has gone all out of this market. We are definitely in choppy territory, and that's, I will tell you, perfect for shorter-term strategies like the frog or the intraday regression line crossovers, which have just been killing it in the trade room. I got to tell you, that's going to be the third bundle I have Bill working on. So it's going to go blended monthly, then frog, then regression line crossover. I mean, it's just been dominating. The jaws of PPO are still open to the upside, although they're hesitating a little bit here because of that big sell-off on Thursday, but still favorable. We have room to go here on the Williams %R. That's favorable. And a lot of room on the ADX for a bull trend to develop. So what I would say on this one is to make the case for the bullish side. Let me try it this way. To make a case on the bullish side, I really want to see it hold above this 131. I would like to see it take out 134 and then close above 136. And as long as it's up in this area, we'll be fine, and then we'll be ready for another run at 142. If we get above 142, then this whole 3-month choppy this whole 3-month choppy trade over in here will be done once it can get above 142. So we got a lot of work to do, but we're still there's room for it to do that. There's been a considerable this pullback has been considerable right in here, and so now the room for gains later in the summer are available. The case for the bear side to me is equally obvious, which is why this is a good day trading kind of market, and that is at 130. If 136 cannot be breached, then what you had is 142, then a swing high at about 140, another run at 136, and then you'd see lower lows, and then I'd be looking for a target down here around 125. So if this 132 can't hold, then it's a test of 130-ish, and then if it breaks, then we're back around the 200-day moving average, and then from there it's all straight down. So to me, this is a perfect area for taking your profits when you get them, minimizing your overnight risk, being available for these large one-day candle moves. It's a very volatile market, and so strategies like the frog are going to do very well on these big candles that have large bodies and small tails. So that should be part of your trading arsenal. Okay, moving on. Next one up is the Etf Regional Report. So all of the 10 indexes are on a cash signal. That keeps us at 0% invested, 100% cash in the long-term theoretical model. SPY is still better than EFA because SPY at 65 is better than EFA, the rest of the world, at 50. And then inside the U.S., it goes technology, large caps, small caps, and then mid caps. So it's U.S. better than the world, and then the cautious strategy with large caps and tech ahead of the smalls and the mids. Two weakest remain Latin America and emerging markets. Moving on. Next up, the world market model. The large caps and selected small caps are above average inside the U.S., but all the mids and then mid cap or small cap value below average. Treasuries, bonds, and real estates looking good in the alternate asset classes. Japan, Asia list, Japan continue to be weak. China, the big laggard in Asia. Malaysia and Singapore continue to have the strength there. Mexico has come up above average, but Latin America and emerging markets are suffering. All of Europe is suffering, as you can see. Inside the business sectors, both U.S. and globally, it's the defensive plays that are working. It's consumer staples, utilities, healthcare, and then lagging are the producers, materials, energy, finance, and industrials. So it's still the risk-off trade when it comes to equities. So that should tell us that the XLP and XLVs of the world should still continue to be doing well inside the sector spiders. And that's what we'll see on the next chart. Next up is the ETF top 30 from the ETF2 database. Biotech and home construction, and now it's the defensive pharmaceuticals, retail, dividend leaders, financial preferreds. Those are ones that have pay a dividend and are extra protection. Mortgages, mortgage REITs here. Lots of bonds. Here's XLP, the sector spider for consumer staples. More REITs, preferred stocks, more REITs, and then utilities. So you can see it's definitely risk on, risk off, excuse me. Next up, the Dow 30 components using the same general lens. It's the consumer staples again: Disney, Verizon, Walmart, Home Depot, Merck, Coke, Pfizer. At the bottom are the producers: Caterpillar, Hewlett-Packard, Cisco, J.P. Morgan, Alcoa, Procter Gamble. Procter Gamble and McDonald's still look to me to be anomalies here, and those are, for a value player, those two look very interesting to me. Being that they've been so relatively weak, I still think there's a value play available in them. Moving on. Next up, just looking at the daily liquidity and volatility among the ETF 30s. I'll just highlight for you the VXX has been a fantastic trade for me the last 2 or 3 weeks. I mean, this 8.6% intraday volatility has really been extraordinary. I'll show you some charts on that one. IWM, I just want you to notice, IWM has really been the aggressive trader vehicle of choice. It's trading $4.2 billion compared to $3.3 billion. So it's 33% more liquid than the Qs, and it's been more volatile. So there's 2% and more liquid, whereas the Qs are not much more liquid than the S&P itself. So small caps definitely got to be on your radar for the shorter term trading. And although we are in a bull volatile market right now, on a historical basis, this volatility only looks volatile here when compared to these extraordinary dips back here that we had. On a historical basis, you can see that we are nowhere near the volatility of truly horrendous bears. And so, so the volatility index still has potential for excellent trading. Okay, moving on to the daily. And as I mentioned to Paul, I will get the updated version of this posted and distributed. Sorry about the confusion. All right, so on the daily, I'm not going to redo the top bar, so we'll just go straight to. As we pulled back from overbought conditions, now right in the middle on the 10-day NDX. No signals in overreaction or channeling. The volatility has actually started to roll over here. So I would call that, I guess, recent volatility starting to level off. If it doesn't get much more volatile here, then pretty soon we'll start dropping off these periods of low volatility, and then this will start looking like normal as this oscillator, this indicator, starts to adapt to the most recent 100 days. The only pattern trades, we got channeling for the utilities and IBM. Got some 551Ws to look at. And then just a whole bunch of auto-framed trades. And that's a function, if you'll recall, of that max pain range compression, which creates the conditions for a short-term pop on a test of the 10-day high. So there's a lot of goodies in there. Among the max pain candidates, these are potential, symbols that had overly negative reactions. Hewlett Packard, Procter Gamble, Caterpillar, Chevron, Alcoa. The VIX, gold miners, silver, oil, and oil services. The winners have been all the XLPs of the world and biotechs. Moving on. Okay, now the Dow Tactical is up next. We've got a handful of 551Ws. We got this IBM channeling, as you can see. A bunch of 551Ws. The top 5 max pain range compressions: Procter & Gamble, Hewlett Packard, Caterpillar, Walmart, and Chevron. They all test out better than 2-to-1 on the reward to risk ratio, except Walmart, which is close. You have McDonald's testing out at 3-to-1 on the reward to risk, and so that's a potential value play. There's no pattern for, no particular pattern, but just the fact that it's been lagging while the rest of the staples have been doing well, and it tests out at 3-to-1, automatically makes it of interest to me based on trade location. I'm interested in Caterpillar here and Procter & Gamble. I mean, really, it's got a fraud quality number of 3.3, excuse me. It was not a percent loser, nor a winner, so, the emotional sell-off is over, and it tests out at 5-to-1 on a reward to risk ratio. And Procter & Gamble, I mean, I'm going to make a note to see if we can't look at that chart here. Get to the end, Procter & Gamble, and we'll look at McDonald's as well. It was also an RSI 2 signal at 10, so that means it closed in the bottom 10% of its range on Friday when everything else was up, and it didn't lose money. It just was very near its low of the day, so there's some potential. Merck is pretty interesting too. In fact, it had multiple big day breakouts. So let's look at Merck as a continuation pattern. When we look at the charts. Okay, moving over to the ETFs. A handful of dojis. We got a channeling here in XLU. We've got 3 551Ws. In industrials, consumer discretionary, and Asia less Japan. You got a whole boatload of things that are set up on the auto framer. And then among the max pain range compressions, silver, the VIX, blended commodities, gold, oil, and utilities, all looks good. Silver closed in the bottom 5%, and with its price at 26.15, I'm automatically interested in silver. And then utilities closed in the bottom 10% of their daily range. To me, that strengthens the argument for an equity pop on Monday, with commodities and defensive sectors out of favor. And so now there's plenty to choose from here. Okay, moving on. Next up, we'll look at the market mosaics. We have a sideways market, and with the R squared at 0.008, what you have is a lot of price above the horizontal line, a lot below it, a lot above it, lots of volatility. That is a pure sideways kind of a grinding market. It has improved considerably on the slope of its regression line. As you can see, this crossover occurred right in here, and so that is, we would interpret that as being this move right here is very positive based on the regression line rolling over from an extreme. So that is this rollover period here. That's got to be seen as a potentially very important swing low. And so now what we have is we had a first surge up, and now we've got this little pullback. This provides a perfect opportunity to get in at a fair price. So if it can get above this 136 with the stop down here, this will be a very powerful move. A low, a low, a low, and now what it's really got to do is take off and start making the bear side or the bullish side case and get up there and test that previous swing high at 142. That's what we're looking for. We'd like to see it leave here and come up and test these price levels. All right, that's going to be our targets. That's the case for the upside. Failure here, though, it comes down to the 200-day moving average, and if it doesn't hold there, you know, the next stops are here and here, and then it gets ugly in a hurry. So this is truly climbing the wall of worry. You have the next chart up is relatively new. This is looking at the z-scores of the regression line slopes. What you had was a nice move on the 10. It has pulled back into the river, but still above zero. The 30 has made a nice move and is now positive. And you can see now that the 90 has even rolled over near the bottom of the plus or minus 1 channel, and you can see it's actually slowing down. Perhaps you can see that. I can see that. You notice that the rate of slope has degraded, so it's actually starting to roll over and ready to come back up. Now, what you'll notice is if the last time when the 90 can move from here, the bottom of its channel to the top here, that corresponds with this kind of sustained move in the market right here. So that's that's a nice chunk. That's a nice piece of movement right there. And it can stay out of the channel for a long period of time, which was that second leg up. And with the, you can see the Bollinger Band width getting narrower as the bottom channel has started to roll up, as has the top. It came from below the river, through the river, hesitating, and now ready to go. So again, this is a case for a market in transition in the grinding sideways, but with still bullish tendencies. That all looks favorable to me, and I'm treating this sell-off here as an important swing low, intermediate term low until proven otherwise. So all the preconditions are in place now for a nice retest back up to 142, and that's going to be my bias for right now. That's the triangle that I see. And this examines the descriptive statistics around the Bollinger Band width. And what I just want, in terms of the width of the Bollinger Band, what I want you to notice is the decline of volatility over the last 180 days. This was during the sell-off, and now the Bollinger Band width is below average and declining. That's a sign of volatility coming out of the marketplace. So to me, that reinforces the bull side. You can now on the Z price, the Z of the 30-day price, you can see that has generally been moving up. And with the Z-score right around 0, there's still plenty of room for it to get up to into this area. If the Z-score gets up in this area, that will signal a retest of 142. And so that is not an abnormal kind of a move that's available. That sell-off on Thursday last week provides an excellent opportunity for value entries in the leading sectors and stocks. Looking at quality candidates here for the frog. And this is a combination now. This ranking is based on a combination of both the frog quality number and the intraday volatility. So you can accept a little lower quality on the frog if it's got an exceptional frog quality number. And so that's what makes the VIX right now a brilliant intraday trade. Because the intraday volatility is so great, it can have a marginal frog quality number and still be very powerful. But meanwhile, Bank of America, JP Morgan, Alcoa, Caterpillar, Hewlett Packard, Brazil, these are all those lower-end companies that have been selling off. Much more volatile intraday, bigger moves. These ones here that test out at 3.0, Caterpillar, Alcoa, JP Morgan, are the best of all possible worlds. Again, better than 3 and very volatile on a relative basis. So that becomes more decisive when the frog works. That's how I use that chart. We're going to skip through the range stat. I just want to highlight a couple things here on signal to noise ratio. The VIX, Walmart, real estate, Hewlett Packard, Cisco, Caterpillar, and ILF, the Qs. These are all symbols that have that are very directional intraday compared to the rest of the Dow 30 and the ETF 30. These have large directional moves. All of them, more than 50% of their daily candle on average has been directional, and so that makes them also very good candidates for these short-term, intraday kinds of moves. Moving on. Okay, I want to stop there, and I want to take a look at some of the let's take a look at a couple charts for setups. And let's see, the first one we wanted to look at was, let's take a look at McDonald's. This was a value play. Beautiful. You can see this. This is the trading range right here. And we've got a nice measured pullback. 4 days, big sell-off, and then an inside day, a doji. It's the least volatile of the last 4. Get a nice entry at 89 with just a test of 91, and a dollar stop. There's your 2-to-1. That one to me is a natural to consider. And you could see a test up here to the 50-day moving average and a return to the 200-day moving average. And if it gets above there, people say, hey, McDonald's is back and it's on its way to 98. So you get a chance to get a very low-risk entry in a structured way on McDonald's. That should be on your swing trade radar screen. Next one I wanted to look at was, let's see, Merck, MRK. This is one that featured that brilliant breakout. Boy, don't you love that. And we've been mentioning for like 2 or 3 months that all the XLPs of the world have been doing well. And so the leading stocks and the leading sectors, there got to be ways that if you start framing these as mechanical trades, that you're going to get some rewards. This one, I mean, why wouldn't you want to own that one, I guess? Well, it takes out the previous swing high. So this is the move. How much of that move could still, but let's just make that bigger. Yep, there's still plenty more room in Merck. You know, with equities just being you know, very cautious and tentative right now after this, what was a 10% pull-off back to the 200, and people want to start incrementing money back in. Does it make sense to consider the strongest stocks in the strongest sectors? And Merck, that's got to fill everybody that owns that with confidence. None of those people are inclined to sell. There's only buying pressure left on Merck. That still looks good. Let's take a look at the other end of the pharmaceuticals, though, and that was Procter Gamble. That's the difference between strongest stock in the strongest sector and the weakest stock in the weakest sector. So if you feel like you want to get into the pharmaceuticals and you want to specialize in a company, you know, that's a pretty good before and after kind of picture. It's easier for me to see value in something like Procter & Gamble because I can set up structured trades here. Like I can buy this at 66.5 with a stop here and reason to believe that it could close the gap at 62 and then get up to 64 and hit the indexes and then maybe close the gap to 67. However, Merck is already doing that stuff. So I guess it's a matter of personal taste. That if you see XLP doing well and healthcare doing well, and you saw Merck doing well, why wouldn't you want to just jump on Merck the instant that it is doing better than SPY? Because then you know you have company buying pressure. So keep your eye on Merck. All right, I want to shift over to just take a look at a couple, just I guess learning insights from the intraday treatment. Let's see what we've got here. I don't think I covered this last week, so I will mention it again then. All right, I've been doing some research on you know, classifying days based on their froggishness, and that is really how much signal compared to noise they had. So I went and looked back at you know, 10 years of daily charts on SPY, and I was looking at for symbol SPY how many days SPY the open was within the bottom 20% of the day, and then the number of times it was in the top of the day. Yeah, okay, so these are the opens here. I'm sorry. This is open, and then these are the close. Right? So basically 20% of the time and 21% of the time. So in other words, total of 41% of the time, the market opens or closes in the bottom 20% or at an extreme. And what this says is that 42% of the time the opening is at an extreme, by which I mean in the top 20% or the bottom 20%. So 80% of the move is away from the opening or the closing. And what that tells you is a considerable amount of days you're going to get large-bodied candles. And so if you've got a frog quality number of 3 or better and are using the standard deviation of the range, then what you have is a lot of opportunities to get large R multiples, whether the opening was an extreme up or an extreme down. The right-hand side of the chart was just looking at when did you get combinations of that the opening was in the bottom and the close was at the top, and vice versa. So I'll give you more stats on that next week. But the main point is on the left-hand side of this chart, and that is that 42% of the time, the opening is at the extreme end, either the up or the down, of that daily candle. So you get a lot of large moves potential. All right. Let me shift now to a couple other specific charts. This one was an SPY, and this was a quiz from the chat room when I asked Miguel to take a look. What's the difference in the price behavior in these 3 boxes? The blue one, then the green one, then the blue one. And he correctly identified we had a sideways quiet channel in the first box. Why? Because the price, which is the orange ribbon, I should say, that is a 2-period Bollinger Band on a 3-minute chart. So that's showing you where 70% of the price in each of those 3-minute candles is inside that range of the orange. That was what I would describe as the normal price range. So the first rectangle looks like a sideways quiet channel because you have the Bollinger Band mean, which is the red line, is flat and inside. It's always inside the river, has to be, but it's horizontal. The Bollinger Band has pinched, so it's quiet, and you have the 10 and 30 period regression lines and most of the price inside that constrained area. Then at the green circle, you have a breakout when price and then the 10 followed shortly thereafter by the 30 all leave the river, and as they start going up, what you have is you don't have this choppiness. You have an expansion in the Bollinger Bands. You have the Bollinger Band mean leaving the volume weighted average price behind. You can see the jaws opening up here. Price gets outside of the river and stays outside there. The 10 crosses the 30 and stays out until you get up near this red candle, and now this easy running, as I would call it, you know, the Jamaican bobsled team, you know, cool run-ins, bruh. All the easy moves now start getting harder. When it's right in here, it's very easy. Feels natural. Then you start getting this choppiness and coming back to test the edge of the river. This is where I get out. Somewhere in this choppiness, I feel like I got to get out of here. When it crosses over, you'll notice at the regression line crossover, you have to be out by that time anyway, and your target is the Bollinger Band mean, which is what it did. When it gets down around the Bollinger Band mean, look how that price gets very clustered in this noisy area. There's no edge in there. The edge is when it gets directional down here, when it leaves the river. When the river is flat and narrow and it breaks out, that's where the herd wants to cross. It's the easiest place. That's where the crocodiles in the river have the fewest chances to chew you up. So when it breaks out, that's when we're going, sideways quiet channel, and then it's easy until it gets hard again. All right, moving on. Here's a trade. This was looking at going short UVXY. This is the double inverse volatility ETF. But it's just a matter of scale. It's the same idea. It's just very easy to see. You got sideways quiet channel in the yellow box. In this blue circle, you have price and the 10 and the 30 period regression lines all leave the river at a narrow point, and now the Bollinger Band mean starts to roll down. It's pulling away from the VWAP. This is the beginning of trending behavior inside that blue circle. And then if that's your entry, where is the stop? The stop is going to be, above the swing high. You could put it right here, or above the red line, or just above the far side of the river. Anywhere in here, even if you took just at the top of the river, which is about 12.28, and if you get an entry at 12.10, you're talking about 20 cents. And then the move goes from 12.10 down to 11.20. That's 90 cents. That's a 4R, almost a 5R move based on this initial measured risk. I think you have to pay attention to those kinds of opportunities. They happen with regularity. It's dramatic inside this volatility ETF, but that's just a mirror image of what all the large indexes are doing. So there are some reliable opportunities every day in the futures and in the index ETFs, to say nothing of when you're framing swing trade candidates or things that have a higher propensity to move that you are specializing in. So I think you have to pay attention to those kinds of moves. Here's one from Friday. So this is SQC 2012-06-22 TNA. TNA is the 3X leveraged ETF for the small caps. And so what we have here is sideways quiet channel in the box. Why is it sideways quiet channel? Because price and both regression lines are inside the channel of the river, and the Bollinger Band mean is flat, and the river is narrow. Sideways quiet channel. Here's the breakout from sideways quiet channel. Price and the 10-period regression line leave, followed shortly thereafter by the black line, which is the 30-period regression. So your initial entry, let me open this up a little further. There we go. So your initial entry should be at 48.70 with a 30-cent stop. So 48.70 is this blue line here. Here's a 30-cent stop, and that's even closer. 48.40 is really that's the VWAP. That's a 30-cent stop down to the VWAP. Price leaves. It's joined by the 30-period regression line. When it breaks out above this 48.85 previous daily high and clears that, I add a second position at 48.95, again with a 30-cent stop, just for consistency's sake. And that's 1R in hand from the original position too. It got up here into 49.40 and started to roll back over. I decided to get out at 49.33, and what that gives you on two bullets. The first one is 2.1R, this move from here to here. 2.1R, this move from here to here. 1.3R. Total net 3.4R. Total time in the trade, not that long. If we look at the time in trade, that's at about 13:30. This is at about 14:15. That's 45 minutes. 3.4R. I love sideways quiet channel. I love when people tell me they can't trade at lunchtime. I love that. Sure you can't. You know, I mean, you have to be a lot quicker and more energetic to get these swings. Now, these are decent swings down in here intraday, but to me, sideways quiet channel, I love that. I love sideways quiet channel. And it's all using the same lens as the regression line crossover. And so what you end up being able to do is with a single set of lenses, you can look to trade these areas in here with regression line crossovers and reversals, and then trade this period in here with sideways quiet channel, all using the same lens. So I'm excited about that bundle coming along after we do the frog. So it's going to be for TradeStation. Blended monthly rebalancing, then the frog, then regression line crossover. And I'll send out a note on that as well. All right, so we're into this about an hour now. I'll go ahead and stop my presentation there and stick around for a few seconds for, oops, I'm sorry, Pete asked me. Do I move my stops up, and if so, when? Well, Pete, as soon as I, on this last example, when I have 1R in hand, I am never going to lose money on that trade. I mean, just, you know, for crying out loud. When it got up into this, I'll show you on this chart here. Before I put this second position on, I have already moved my stop up to better than break even. So I'm up in here on the first position. Because what I don't want to do is add a position and then have them both go south against me and then turn a 1R trade in my favor into a losing trade. So I like to get to better than break even, and you know, enough to pay for the round trip and a fractional win. As soon as I can lock in that first piece, just like a mountain climber, tapping in protection. I like to raise that stop. As soon as that thing starts moving in my favor, it's left the river, and I will tell you, when it cleared this little congestion zone up in here, I've already moved my stop up. So that's one that you just got to get develop some skill with. But I do not like to let winning trades move against me. Yeah, Mark, I noticed that. I'm going to send out the daily here. As soon as the conference is over.